Welcome to our deep dive into financial modeling, a crucial skill for investment bankers. In today's fast-paced financial world, the ability to build, interpret, and utilize financial models is essential for making informed decisions. Whether you're evaluating mergers, acquisitions, or investment opportunities, mastering these techniques can set you apart. In this video, we'll explore the foundational concepts, walk through practical examples, and highlight the best practices every investment banker should know. Let's start by understanding what financial modeling truly means and why it's so important in the banking industry. Financial modeling is the process of creating a mathematical representation of a company's financial performance. These models are used to forecast future results, analyze business scenarios, and support strategic decisions. For investment bankers, financial models are indispensable tools for valuing companies, assessing risk, and structuring deals. By inputting various assumptions and variables, bankers can simulate different outcomes and make data-driven recommendations. Understanding the basics of financial modeling lays the groundwork for more advanced techniques, which we'll cover in the following scenes. Robust financial model typically consists of several core components: the income statement, balance sheet, and cash flow statement. These three financial statements are interconnected and provide a comprehensive view of a company's financial health. The income statement shows profitability, the balance sheet details assets and liabilities, and the cash flow statement tracks liquidity. By linking these statements, investment bankers can ensure consistency and accuracy in their analysis. Let's break down each component and see how they fit together in a typical model. Income statement is the starting point for most financial models. It summarizes a company's revenues, expenses, and profits over a specific period. Investment bankers use this statement to assess a company's operational efficiency and profitability. Key line items include revenue, cost of goods sold, gross profit, operating expenses, and net income. By projecting these figures, bankers can estimate future earnings and identify trends. Accurate income statement modeling is vital for reliable forecasts and valuations. Balance sheet provides a snapshot of a company's financial position at a specific point in time. It lists assets, liabilities, and shareholders' equity. Investment bankers analyze the balance sheet to evaluate a company's solvency and capital structure. By modeling assets such as cash, inventory, and property, alongside liabilities like debt and accounts payable, bankers gain insights into financial stability. Linking the balance sheet with other statements ensures a complete and accurate model. Cash flow statement tracks the movement of cash in and out of a business. It's divided into operating, investing, and financing activities. Investment bankers rely on this statement to assess liquidity and the company's ability to meet obligations. Modeling cash flows helps identify potential cash shortages or surpluses, which is critical for deal structuring and risk assessment. Accurate cash flow projections are essential for a reliable financial model. Key technique in financial modeling is linking the income statement, balance sheet, and cash flow statement. This integration ensures that changes in one statement are reflected across the others, maintaining consistency. For example, net income from the income statement flows into the equity section of the balance sheet and is the starting point for the cash flow statement. Properly linked statements allow for dynamic scenario analysis and more accurate forecasting. Every financial model relies on a set of assumptions and key drivers. These include growth rates, margins, capital expenditures, and working capital changes. Investment bankers must carefully select and justify these assumptions, as they directly impact the model's outputs. Sensitivity to these drivers allows for scenario analysis, helping bankers understand how changes in variables affect outcomes. Clear documentation of assumptions is a best practice in professional modeling. Forecasting is at the heart of financial modeling. Investment bankers use historical data and market trends to project future performance. Common techniques include trend analysis, regression models, and ratio-based forecasting. The goal is to create realistic projections that inform investment decisions. By combining quantitative methods with industry knowledge, bankers can build credible forecasts that withstand scrutiny from clients and stakeholders. Scenario and sensitivity analysis are powerful tools for assessing risk and uncertainty in financial models. By adjusting key assumptions, investment bankers can evaluate how different scenarios, such as economic downturns or market booms, impact financial outcomes. Sensitivity analysis focuses on how changes in individual variables affect results. These techniques help bankers prepare for a range of possibilities and make more resilient recommendations. Valuation is a core application of financial modeling in investment banking. Common methods include discounted cash flow (DCF), comparable company analysis, and precedent transactions. Each approach has its strengths and is suitable for different situations. Investment bankers must understand when and how to apply these methods to arrive at fair and defensible valuations. Let's explore each method in more detail in the next scene. DCF method estimates a company's value by projecting future cash flows and discounting them to present value. This technique requires careful forecasting and the selection of an appropriate discount rate. Investment bankers use DCF to assess intrinsic value, especially for companies with predictable cash flows. The accuracy of a DCF model depends on the quality of assumptions and the rigor of the analysis. It's a fundamental tool in the banker's toolkit. Comparable company analysis involves evaluating similar businesses to estimate a target company's value. Investment bankers identify peer companies and analyze valuation multiples, such as EV, EBITDA, or PE ratios. This method provides a market-based perspective and is often used alongside DCF. The challenge lies in selecting truly comparable firms and adjusting for differences. When done correctly, this approach offers valuable benchmarks for valuation. Precedent transactions analysis looks at past deals involving similar companies to determine valuation. Investment bankers review transaction multiples and deal structures to inform their own valuations. This method reflects real market conditions and investor sentiment at the time of each deal. However, it's important to adjust for differences in timing, size, and market environment. Precedent analysis is particularly useful in M&A scenarios. Mergers and acquisitions (M&A) are a major focus for investment bankers. Financial modeling in M&A involves projecting the combined financials of two companies, assessing synergies and analyzing deal structures. Bankers must evaluate the impact on earnings, cash flows, and shareholder value. Accurate M&A models help identify the benefits and risks of a transaction, guiding negotiations and decision-making. Leveraged buyout (LBO) modeling is another essential technique for investment bankers. In an LBO, a company is acquired using a significant amount of debt. The model projects how debt repayment and operational improvements affect returns. Bankers analyze cash flows, debt schedules, and exit scenarios to determine the feasibility and attractiveness of the deal. LBO modeling requires a strong grasp of both finance and deal mechanics. Designing a financial model requires attention to detail and adherence to best practices. Investment bankers should use clear labeling, consistent formatting, and logical structure. Inputs, calculations, and outputs should be separated for transparency. Using color coding and documentation helps others understand and audit the model. Following these practices ensures models are reliable, scalable, and easy to update. Even the best designed models can contain errors. Investment bankers must rigorously check their work, using techniques like reconciliation, cross-checks, and audit trails. Automated error checks and validation rules can catch inconsistencies early. Regularly reviewing assumptions and formulas helps maintain model integrity. A robust error checking process builds confidence in the model's results and supports sound decision-making. Transparency is vital in financial modeling. Investment bankers should document assumptions, sources, and methodologies clearly within the model. This practice allows others to review, understand, and update the model as needed. Good documentation also facilitates collaboration and ensures compliance with internal and external standards. Ultimately, transparency builds trust in the model's outputs. Microsoft Excel is the primary tool for financial modeling in investment banking. Its flexibility, powerful functions, and widespread adoption make it ideal for building complex models. Investment bankers leverage features like formulas, pivot tables, and data validation to streamline their work. Mastery of Excel shortcuts and advanced functions can significantly boost productivity and model accuracy. Beyond the basics, advanced Excel techniques can enhance financial modeling. Investment bankers use tools like macros, conditional formatting, and scenario managers to automate tasks and visualize data. These features help manage large datasets and complex calculations efficiently. Learning to use these advanced tools can set you apart as a skilled modeler in the banking industry. Even experienced bankers can fall into common modeling traps. These include overcomplicating models, using inconsistent assumptions, or neglecting error checks. Avoiding these pitfalls requires discipline and adherence to best practices. Regularly reviewing and simplifying models can improve clarity and reduce the risk of mistakes. Awareness of these issues is the first step to building better models. Stress testing involves evaluating how a financial model performs under extreme conditions. Investment bankers simulate adverse scenarios such as economic downturns or market shocks to assess resilience. This process helps identify vulnerabilities and prepare contingency plans. Stress testing is a critical step in risk management and ensures models remain robust in uncertain environments. Effectively communicating model results is just as important as building the model itself. Investment bankers must present outputs clearly, using charts, tables, and executive summaries. Tailoring presentations to the audience, whether clients, colleagues, or management, ensures key insights are understood. Strong presentation skills help drive informed decisions and build credibility. Financial modeling is often a collaborative effort. Investment bankers work in teams, sharing models and insights to achieve the best results. Using version control, shared drives, and clear communication helps prevent errors and ensures everyone is aligned. Collaboration also fosters learning and innovation, leading to stronger models and better outcomes. Ethical considerations are paramount in financial modeling. Investment bankers must ensure their models are objective, transparent, and free from manipulation. Misrepresenting data or assumptions can lead to poor decisions and damage reputations. Upholding ethical standards protects both the banker and the client, fostering trust and long-term relationships. The field of financial modeling is constantly evolving. Investment bankers must stay updated on new techniques, tools, and industry trends. Continuous learning through courses, certifications, and peer feedback ensures skills remain sharp. Embracing a growth mindset leads to better models and greater career success in investment banking. Different industries require tailored financial models. Investment bankers must adapt their approach based on sector-specific drivers, such as regulatory requirements or unique revenue streams. Understanding industry nuances ensures models are relevant and accurate. This adaptability is a key skill for bankers working across diverse sectors. Incorporating real-time market data enhances the accuracy of financial models. Investment bankers use data feeds, APIs, and market research to update assumptions and projections. This integration allows models to reflect current conditions and respond quickly to changes. Staying connected to the market is essential for timely and relevant analysis. Automation is transforming financial modeling. Investment bankers are increasingly using scripts, templates, and specialized software to streamline repetitive tasks. Automation reduces errors, saves time, and allows bankers to focus on analysis and strategy. Adopting automation tools is becoming a standard practice in modern investment banking. Regular auditing and review are essential for maintaining model quality. Investment bankers should schedule periodic checks, involve independent reviewers, and update models as new information becomes available. This process helps catch errors, validate assumptions, and ensure models remain relevant. A strong review culture leads to more reliable and trusted outputs. Communicating complex financial models to clients requires clarity and empathy. Investment bankers must translate technical details into actionable insights, using simple language and visual aids. Building strong client relationships depends on effective communication and responsiveness. These skills are as important as technical modeling expertise. Time management is critical in investment banking where deadlines are tight and stakes are high. Efficient modeling processes, prioritization, and delegation help bankers deliver quality work on time. Using templates, checklists, and automation can streamline workflows. Mastering time management ensures models are completed accurately and efficiently. Uncertainty is a constant in financial modeling. Investment bankers must be prepared to adjust models as new information emerges. Building flexibility into models, such as using dynamic inputs and scenario analysis, helps manage uncertainty. Being proactive and adaptable ensures models remain useful in changing environments. Sometimes, investment bankers need to consult external experts such as industry specialists or technical advisors to enhance their models. Leveraging outside knowledge can improve assumptions, validate projections, and add credibility. Building a network of trusted experts is a valuable asset for any banker. Compliance with legal and regulatory standards is non-negotiable in financial modeling. Investment bankers must ensure their models adhere to relevant laws, industry guidelines, and internal policies. Staying compliant protects both the banker and the client from legal risks and reputational harm. Regular training and updates are essential for maintaining compliance. Technology is rapidly changing the landscape of financial modeling. Investment bankers must stay informed about new tools, software, and data sources. Embracing innovation can lead to more efficient, accurate, and insightful models. Being open to technological change is a hallmark of successful bankers in today's digital world. Investment bankers often work on cross-border deals, requiring models that account for global factors. Exchange rates, international regulations, and cultural differences can all impact financial outcomes. Building models that incorporate these elements ensures more accurate and relevant analysis for global transactions. Modern financial models often require handling large volumes of data. Investment bankers use data management techniques such as filtering, sorting, and summarizing to keep models efficient and manageable. Leveraging database tools and data visualization can further enhance analysis and decision-making. Every client has unique needs and objectives. Investment bankers must customize financial models to address specific questions and scenarios. Tailoring models demonstrates attention to detail and enhances client satisfaction. Flexibility and responsiveness are key to delivering value through modeling. While financial models are quantitative by nature, qualitative factors also play a role. Investment bankers consider management quality, market positioning, and competitive dynamics when building models. Integrating these insights provides a more holistic view and supports better decision-making. Financial models must be regularly updated to reflect new data, market conditions, and strategic changes. Investment bankers should establish routines for reviewing and revising models. Staying proactive ensures models remain relevant and useful for decision-making over time. Not every model will be perfect. Investment bankers should view failures as learning opportunities. Analyzing what went wrong, whether it's flawed assumptions or data errors, can lead to valuable insights and improvements. Embracing a culture of learning helps build more resilient and effective models in the future. Mastering financial modeling can open doors to career advancement in investment banking. Skilled modelers are in high demand and often take on leadership roles. Developing expertise in modeling not only enhances technical skills but also demonstrates strategic thinking and business acumen. Investing in your modeling skills is an investment in your future. Summary: financial modeling is a foundational skill for investment bankers, enabling informed decisions and strategic insights. By mastering essential techniques, from building core statements to advanced scenario analysis, you can add significant value to your organization and clients. Remember to follow best practices, stay updated on industry trends, and continuously refine your skills. Thank you for joining this journey through Financial Modeling Essential. Keep learning and applying these techniques to excel in your investment banking career.